This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, December 17th, 2017. All right, so now we're starting to get some pretty interesting developments here on the charts. We were down, nothing really big if you look at it. This wouldn't be what I would consider a capitulation type sell-off. Could prove to be a selling climax. I don't know if you can make it out here on the charts. So there was some decent volume. Here's the volume bar down here. I have my volume bars turned down so they're not distracting. But so it was above average volume for sure, but a little bit lower than some of the recent spikes that we had, and certainly lower than what we saw back here in that first wave down, the first correction back in late January to early February. But what we did do today is came within, basis points or very close to the reaction low in SPY back from the early February lows, and we slightly undercut the early April lows. So early, way back when we were up here and all the way heading into that divergent high, that was my target area. I was looking for a move down there, and what I was saying leading up to this is that one of two things would happen, what I suspect. Since a lot of eyes were also looking at that level, I figured we'd either reverse just shy or undercut it. And that's still, so now the undercut is in play. Maybe we come right off here. Now keep in mind also, QQQ, I'm going to get to in a second. QQQ has not met those lows yet. SPY has. So and QQQ really started this whole thing, was led down by the market leading FANG stocks, the big tech names, and plus Amazon. So either way, here's the thing. Keep it very simple. We are at support. This is a well-watched, very important support level. So we're pretty much closed or came, at the lows today. We had a little lift right into the last 10 minutes of trading, right down on that support level. And, I still think, well, we get a decent bounce. In other words, the next 8 to probably 10%, I believe, from here is most likely to the upside, not the downside. Anything's possible. We can't rule out a meltdown scenario. I talked about it back here and here and here, about how the funds were caught off guard, hedge funds, pension plans, because of this. Their asset allocation models pretty much broke. Nothing was working. Everything's gone down in unison. Most instruments. We're finally seeing a flight to safety bid on gold and treasuries and all that lately. But for the most part, that's you can look at a pretty healthy correction that has now come down to a well-watched support level, with most importantly with these potential divergences, and we're close to being oversold. And remember, we were deeply oversold the first time around, and that's what gives us divergence. As prices continue lower, the momentum indicators, the RSI and the PPO, are making considerably higher highs. They're still pointing lower, so this is what I call potential divergence. It's only confirmed, at least in my book, when you have that bullish crossover. In other words, oh no, we didn't have it there. Remember, on the SPY, we never made a lower low. So this is our potential divergence here, and if we can turn up soon, which I think we will, then look for a nice bullish engulfing candle or any other type of. We don't even have to have a bullish engulfing candle. Bottom can come in form of many ways. Maybe a flush out move tomorrow. Very often when you have the bottoms, at least on these last two corrections, you could see some pretty long tails there on the candles, the shadow, the skinny part. We didn't have that so much today, so we didn't have again much of an intraday reversal. There was a little lift into the close, but every top, every bottom is different in the market. So all I can tell you is we're oversold at support, are very close to it here, and longer term outlook remains bearish. But again, you can only go down so far, so fast before you get a nice kickback rally. So there's SPY, and let's look at what happened we'll get to QQQ last. Let's look at IWM. I'll skip the mid caps, are usually in between the two, obviously, as far as the charts go. And you can see same story, pretty powerful divergences. I mean, these are strong divergences, a much lower low. I'm referring to the slope, how steep that downtrend line is, the divergence line. And remember, divergences, when I draw divergences, these aren't price trend lines because I'm only connecting 2 points. So this isn't a downtrend, if you will. It's just a divergence line showing prices are making lower lows, and divergence lines will move. Trend lines, you have more reactions on a trend line, even though those can need to be modified if prices change. That's trend lines are usually more static, and then you wait for breaks. I just wanted to clarify that. So if we drop down to this very, very solid support here, 133.45, From the lows today in IWM, that was only about another 2% downside. So I continue to maintain. I think the downside here, the risk reward continues to shift to the bullish side. I mentioned on Friday, for the first time in many months since before the top came in, and moving into cash and long-term accounts, IRAs, 401ks, that kind of stuff, shifting money over. Did that again today. So now I've scaled a second lot in there out of cash positions. Probably I'd have to look into the math. I'd say maybe 35, 40%, maybe even 45% now into various, small, mid, large caps, U.S., international. And I'll continue to do the same going forward. If we have another big swoon down, 3, 4, 5%, I'll just continue to add. However, if we reverse sometime soon. Now, here's the thing. I don't expect any fireworks until the Fed. We have the Fed on deck this week with the big FOMC meeting. Usually the markets go into a holding pattern leading right up to the Fed, especially the day of or the day before. So we'll see what happens at, Wednesday at 2 o'clock. So we'll see. Anything can happen. Things are a little bit different this time around with the technicals and the strong downtrend. We usually don't have this, but I can tell you this from experience. Maybe this time is different, but in the past, and I've seen it many times over, especially over the last 10 years, when the Fed started getting really hawkish and talking the talk, jawboning the rates up, saying that we're going to raise rates and get aggressive, they immediately started backing off when the market threw a temper tantrum, and that's what's going on here. So the market's throwing a hissy fit. Basically, they already started backing off. Oops, hit the pause button there. Yeah, I talked about it up here before it even happened. I said, market's going to correct. We're going to go down, and you'll see, mark my words, the Fed, they were hawkish as could be back here, and they started backpedaling and moving to a more dovish stance, coming and say, well, we're not set on doing anything. We'll take things as they come. In other words, they moved in Fed fund futures, the dot plot, the trajected path, or their trajectory, I should say, the projected path, of expected rate hikes has considerably moved down since then. Why? Because, it's the market goes down, the wealth effect drops. And when the wealth effect drops, consumer spending slows. And even before the consumer spending numbers hit, before you even see it in the reports, which of course have a lag time, the economists, they'll forecast that in, that we're going to see that. So that's that. And again, so you get down here and it's just a matter of time. You can want to try to catch a bottom. That's going to be, it could be tough in this one. Maybe we gap up one day, maybe there's some more downside, but I personally, I like that scale, especially if you're not a very active trader. I mean, what I do in long-term accounts and the trading account, two different things. I was in and out today, mentioned going long this morning with futures with a stop below the lows, and then actually raised that up once we rallied and we closed the gaps. It was an interesting day. Let's look at that real quick. Here's what happened on the 1-minute charts. And let's go to SPY. And here's the market itself, the S&P 500. So we moved up, and twice they were able to backfill today's gap and even take the markets positive. All of small caps, QQQ, SPY went positive, and then the sellers stepped in after the backfill in that second attempt and faded it. So yeah, I was stopped out in a couple lots down there. And then I like what I saw at the end of the day, so I took some longs home, and I'll keep a tight stop overnight. That's the thing about futures. You can have your stops hit around the clock. Can't do it with SPY or QQQ. If we gap down 3% tomorrow and you're in SPY or QQQ, well, you're at the mercy of the markets because it's going to open up. Maybe you can get out in pre-market if you're not down too much, but that's tough. You can't use stop loss orders in pre-market. They only limit orders. So futures, that's why I prefer those, especially on volatile times like this. Okay, so bigger picture again. There's those lows back from earlier in the year, and we're pretty much, effectively almost hit that today, close enough. So there may be a little more downside. Again, this doesn't have the look and feel of a capitulation day. We were down 2%. It's a pretty big down day, but not as big as some of the days that we've seen recently. That's not always a criteria to end a down downtrend, but let's look at QQQ. QQQ slightly undercut the recent lows, but just like SPY, like every index out there, and here's the thing, they all have this potential divergence. QQQ had divergence here. It had a nice lift. Every now and then I'll hear comments, oh, divergences don't work, they don't work. Well, they do work. They identified the high here. They identified this low. We had a divergent low in QQQ. Let me move the lines away and tell you what that resulted in from high to low, or from low to high, 10.3% rally. So, things move fast. It's a fast moving market. 10% in many years in the stock market. Forget about the crazy 10 years we just had with the Fed bubble that they've blown in the market with quantitative easing, everything else. 10% in many years is a good year in the stock market, and we had it just a couple weeks there. So I respect these divergences. Again, they are not buy signals, but they are an indication of an impending trend change. It shows you that momentum is waning, that the trend is losing momentum, and once we get if and when we can get a bullish crossover here on QQQ soon. And let's talk about levels. So SPY, I just showed you, effectively hit the lows. QQQ, you can see I have a line, this yellow line, I have it right here, trading normalized. There was a little spike below there on the early February lows, and but that's where we hit. We had a couple reactions right there on the early April lows. So that's about where trading normalized, and that is a likely target. So that would be just another, here, let me measure it out for you. I'll zoom in here, grab where we close, the bottom of the body on that candle, and down to that line, you're talking about 2%. So that seems to be about the number right now if we want to go down and kiss those levels perfectly. Remember, Mr. Market doesn't like to make it easy for everybody. If all the eyes are watching that level, one of two things will happen. As I just showed you in a minute ago, although SPY hit it, QQQ hasn't. So maybe Q's reverse, or maybe they undercut it. But again, I look at it more of a range. So a range that's, from this point now with another 2.25% down today, that gives me, give or take, 2 to 4% downside. But again, I just prefer, especially in the less active, the more buy and hold or trend trading accounts like IRAs and things like that, 401ks, to just continue scaling in here. And because a problem with, especially 401ks, things that have mutual funds, if we have one of those huge, big intraday reversals, a big green up day, and then you decide to go long, the price you're going to get if you tell your 401k to move some money back from cash into stock funds, or if you're a mutual fund trader, you're going to get the 4 p.m. price. So the train may have left the station, or at least a good part of it, if we close up 3% or more that day. And the 60-minute charts that I covered the last couple days, here's that divergence, still there, potential divergence. Not a lot of room left on the 60-minute charts. If we go down much more, the divergences will be taken out, meaning we'll move below the previous lows here, and then we won't have equal or higher lows on the momentum indicators. But again, we do have it on the daily, and I wanted to point it out here whether we have it also right now. Still the potential. Again, I call it potential divergence because the indicators are, and they're momentum indicators, and they're saying right now the momentum is to the downside. Make no mistakes about it. So it's just potential bullish developments. Buy signals will come on things such as we don't have a well-defined trend line. I pointed one out this morning. I believe it was a small short-term downtrend line here, but you get a nice buy signal. Really, let's look for a buy signal in the daily time frame. Ideally, some type of bullish reversal, candlestick pattern, or something like that. But there's QQQ with the divergences in place. Here's SPY, same thing, potential bullish divergences, especially if we can pop up tomorrow, gap up at the open, that might do the trick. Let's look for recovery back above that 263 area. That was a pretty important level recently. That was the roughly triple bottom lows, barring this one little pop down below. Now we've taken that out, but still, that was support, and support once broken becomes resistance. So on a bounce back, let's see what happens there. If the SPY can get above it, that's pretty bullish there. I think there'll be some stops along the way, maybe one around here, but ultimately this rally could take us all the way back up to the top of that range again. And if so, you're talking a pretty nice lift. Could be about 10% or so in SPY. And then to wrap it up, just a quick look at the longer term charts. Like I say, they, by all accounts, they look bearish. But again, well, I should say they looked very bearish over here, and they're looking less bearish, at least for the near term. Again, I'm talking near term to intermediate term. I'm looking out the next, let's say, month or so, 4, 6, possibly 8 weeks. What do I see when I look at IWM? I see, an index, small cap index that's already dropped substantial. I think it's about a 20% drop. I'll have to measure it for you in a second. They've dropped quite a bit more, which is usually the case. They tend to move up and down more than the large caps, but very nice support right here. A lot of reactions on that level, give or take, call it around 134.20, down to maybe 134. And just as I showed you on the daily chart, we're getting close. If that level gets taken out, then I don't see a whole lot. It's actually pretty thin all the way down here. So if we get let's say some big fund blows up or something happens, we get a big meltdown scenario. I just want to point that out. That would be the next stop. I don't think we're going to hit it before we have a substantial bounce, but anything is possible. So I just want to point that out. Very thin. We only had a few trades there. Again, this is a weekly chart. Let's look at SPY and QQQ. Okay, here's the SPY weekly chart. Again, the bigger picture, we broke trend here. We had a trend line off the early 2016 lows. We had a divergent high, very clear, unmistakable negative divergence that preceded this rally. This correction told us it was coming. Breakdown. We're below the 40-week moving average, which is a 200-day as well. And then this is a level I'm watching. Call it give or take 261.30. Now we're below it. So that is bearish, and that's something to note right now. Again, to get a nice rally, we have to snap back above there. This is a weekly chart. All that matters to me is a weekly close on it. So this is only Monday. A lot can and will happen between now and the close Friday. Note that we had several intra-week breaks of that level before. However, they also came to test this trend line. That trend line acted as support. We don't have that now. So if you want to paint a bearish scenario and we can keep going down through here, that's certainly a possibility. So like any trade, you just don't get married to it. That's what stops are for. But as of now, let's see what happens, especially if the markets can hold up into the Fed meeting on Wednesday, and if they come out with some dovish, comments. Then you might see a rally and close back above that level, maybe come back up, test the 40-week again. We'll look at price targets if and when a bottom is in place. We'll do that, and then I might make this an official trade. I have some sectors that I like, as well as some indexes, even some individual stocks. But of course, those will be, if it's an official trade idea, that's for members of rightsideofthechart.com, and therefore I'll share the targets on the site. But I'll always do this general market analysis for the YouTubers, as well as those visiting Right Side of the Chart, checking out the free market analysis. QQQ, remember the Qs led the market up. These are your beloved FANG stocks: Facebook, Amazon, Alphabet, Microsoft, and the likes. You had the longer term, intermediate and longer term, the charts are ugly. You broke this trend line off the mid 2015 lows. Also comes in where most other key sectors like technology, and as well as the S&P 500 I just showed you, or early 2016 lows, well-defined trend line. And this was our sell signal here. We had a shorter term minor trend line that broke right there, triggered the correction off the top. We had a bearish rising wedge confirmed with negative divergence. Check, everything that you want to see. And but again, we've already had a pretty healthy correction off the top. And at this point, again, like I said this morning, all it is a correction at this point in time. We haven't yet hit the bear market threshold on the NASDAQ 100 or S&P 500. Doesn't mean we won't, and I do think we will. It's just a matter of, do we get a decent tradable bounce first or not? We'll see. But what I can tell you with certainty is that we've now fallen to a pretty decent support. I have it at 156.75. Again, there were a couple intra-week pops below there, but if you look at this line, there are a lot of reactions. There's about 3 candles there at that level, 2 candlestick bodies right there, a series of 1, 2, 3, 4, and then another fifth. There's a candlestick tail right there, or shadow. So there's 5 candles, either shadows or bodies, and or that touch that level. We bounced off it right there again, and boom, we closed on it today. So support is support until unless broken. Maybe this level goes And most important, will it go on a weekly closing basis? If we have another move down tomorrow and or leading up to the FOMC announcement or even afterwards, there's certainly the room to undercut this level on a weekly basis as long as we close back above it by Friday. And if we don't, all I can say is I don't believe in any one single. I've seen a lot of commentary posted in the trading room lately from others where some people have a certain number, and if the market goes below there, it's going to collapse. And if it closes above that level, on a certain day, it's going to rally. I don't believe in that. There's not many absolutes in the market. There's a lot of variables. That's why I don't sit here and cover just the charts of QQQ, even if that's all I'm trading, or just the charts of SPY. I look at all of these together, and I want to point out that QQQ is still on support. Again, from the looks of the chart and everything else, and even the looks of the past corrections. Remember, these corrections happen. This one back here was a 26% drop in QQQ. Now, I do need to say, and I've said it before, that NDX, the index itself, didn't drop 26%. That's because there was a mini crash. QQQ is an ETF that attempts to track an index. And like any tradable security, it is prone to flash crashes and mini crashes, and that's what happened back on that day. This is a weekly candle, but there was one day where we had a spike down and a mini crash, and the NDX did not drop that much. But what I'm getting at here is you can see 26% drop, 18% drop, 12, and where are we so far? I have to move that, grab here, come down to the bottom where we closed today, where I'll hit today's low. Let's do that. 16, it's almost 17%. So still not to the bear market threshold, but a healthy correction from high to low so far. And again, not even as much as these two drops right here. So there is certainly the possibility for more, even though we're at support. So it's just a question of, do we bounce first, have a decent bounce before then, and then eventually go on to take out that 20% bear market threshold or not. And then finally, the longest term chart, at least that I work off of. There's yearly charts and quarterly charts out there, but I like to go out to the monthly charts. What that means, every candlestick is 1 month. You can see this goes back to about 1990. Couple things on this chart. Don't forget it, but these are the past bull and bear market. There's the dot-com bubble and the bear market that followed. There's the 2008 financial crisis and Great Recession down there, and here's this entire bull market. So I have two trend lines off the lows back here in the beginning. Although the NDX and QQQ bottomed actually in 2008, every other index, including the S&P 500, all of them, they bottomed in March of 2009, and that's where this trend line picks up anyways. It comes in better. You could move it around, catch that November 2008, but it doesn't really matter. They're close enough. What does matter is I have two trend lines. I have a white trend line, and then this yellow one is what I call the BOD, or benefit of the doubt trend line. If I can draw two trend lines, I will, and I'll do that, because this one captures more candlestick bodies and or wicks. The white trend line, that one's already been broken and back tested. That's pretty bearish. The yellow trend line captures these 1, 2, 3 candlestick wicks right here, is when it comes off that low as well back here in March of 2009. So by that trend line, if I move it up here, we're pretty much on trend line support. So we haven't broken, at least QQQ has not broken the benefit of the doubt trend line. Maybe this is the one that matters. We'll see. But I like to, when you're in an uptrend, it's a safe bet to give it benefit of the doubt. And then we also have this 20 period exponential moving average. Here, let's get rid of those lines. And in fact, let's get rid of all those annotations there. So you can see this 20 period exponential moving average does a pretty darn good job of defining bull and bear trends. You can see here's a great, one of the greatest bull markets in history up until before this one came through the 90s. And there's a couple whipsaws if you look really close, but it's done a pretty bang up job of defining the uptrend. And once it broke, and it didn't just whimper. It wasn't one of these little candles. And by the way, that was, I believe, a 20% drop. That was the Asian contagion back then, if you guys are trading or around investing at the time. But you can see once it broke with conviction, like most key support levels do, and that started the bear market at that point in time. Once the bull market resumed, you can see it did a great job of acting as support. And then in 2008, right after the 2007 top, we broke it, shot back above it, and then boom, gave it up. So you can see, again, it's just done a bang up job of defining bull and bear trends. A couple monthly spikes below. Remember, this is a monthly chart. All that matters is how you close the month. And so we've got a couple weeks left to go in December, but you can see as of now, we've held that trend line. So, if you want to use this the longest term charts and my longest term trend indicators aren't yet telling us we're in a bear market. But as I said before, by the time the longest term trend indicators confirm you're in a bear market, you're going to be past that 20% threshold almost certainly. So you sometimes want to get in front of things, maybe lighten up, as I've said, for months now, lighten up on your 401k long-term stuff, move to cash. The outlook is poor. But I just want to point that out. And it's also it's a support level that we haven't visited since that when we had that volatility and that sideways market back in 2015, 2016. So we tested it on this first monthly candle back in October. The November candle again tested it successfully, and now we're on it right now. So I wanted to point that out. QQQ is on support, at least on that 20-period monthly exponential moving average. SPY, same line. Slice through it a little bit more. It's done a little bit better job on QQQ. SPY is trading below it now, but again, we've got a couple weeks left to go in the month. All right, we'll wrap it up here. So went over the long-term charts, and if we get any developments, you don't have developments very rapidly on the long-term charts. I don't cover them very often. However, we'll watch these 60-minute. We'll watch the daily charts. And again, if nothing else, be prepared for some volatility, some whipsaws back and forth. As a rule, I try not to take positions right in front of the FOMC. Tomorrow will be Tuesday, and again, I think the decision comes Wednesday afternoon at 2 o'clock, if I'm not mistaken, going from memory. And we'll see what happens then. So to that, if you don't listen to another video that I do, or you don't read any of the comments on right side of the chart, I always stand aside and try not to react to the initial knee-jerk reaction. After the FOMC meeting, one thing that you can all but guarantee that you can count on is knee-jerk reactions, and usually you'll see the market rip one way, whether it's up or down, very fast, faster than you or I can get in front of. It's machine-driven with the algos, HFT, high-frequency trading. The initial rip or dip, or the initial reaction, is usually not the one that sticks. It's usually followed by another sharp move the other way, and even then that one can sometimes be reversed. So I call it post-FOMC noise. Point being, what I tend to do is if I have trades that are near their price targets, I'll leave those price targets, those sell limit orders or buy to cover limit orders in place because I want my targets hit. But if I have stops that are close by, I may temporarily suspend those stops, let the dust settle, which is usually that, by the close that day or even later that afternoon, and most certainly by the end of the next trading session. So that'll be Wednesday, and of course I'll do some updates before we get there as well. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.